Hi, everybody. Welcome to the August issue of PRMIA's Intelligent Risk. I'm one of the co-editors, Carl Densom, and I have with me Dan diBartolomeo. Hi, Dan. How are you?
Hi, Carl. Nice to talk to you this morning.
Yeah, great to talk to you. Uh, Dan has written the capstone for the August issue. Your second capstone for us, at least in recent times since I've been an editor, Dan. So we're
Yep,
very happy to see you back. And maybe just quickly, if you are new to PRMIA Intelligent Risk, we interview the capstone author each issue. That's the most prominent article in the publication. The article gets a bit more space, a bit more to get into depth on a very interesting subject, which we're going to get into in a second. And also, if you haven't caught it, my fellow co-editor Steve Lindo just held the webinar with some of our May authors on, again, a topic that's in the now. So if you didn't catch it, there is a recording available, and it's about behavioral risk. So managing behavioral and conduct risk with two of our authors. So try to catch that if you can. But yeah, without further ado, Dan, I'd love to get into your capstone, get the readers a bit of a teaser for what they're going to be able to read in a week or so.
okay.
Um, I'm hoping you can give us some background and tell us maybe why you wrote about the article. And with that, give us a little bit of a history of private credit, specifically for risk managers.
Sure. I guess what motivated me to write this particular article is that in my normal day-to-day job, I deal with a lot of large institutional investors, a lot of asset owners like sovereign funds, some of the very, very large pension schemes in various countries. And more and more, they have been putting money into private credit funds and in some cases, being direct lenders. Now, insurance companies and pension funds have been lenders, particularly to the real estate sector, commercial mortgages, for decades. That's nothing new. I think what is new is the idea that private funds, organized very much like a private equity fund, are now functioning in lieu of bank lenders, particularly to the middle market and larger corporate sector, but not at the scale of typical public companies. So these are typically, the borrowers are typically private firms, anywhere, 10 million and up in sales, up to, a couple of 100 million. So they're sort of middle market companies, may not be overly satisfied with their banking relationships, and so they're willing to go to alternative lenders. The alternative lenders are clearly in a search for yield, because obviously, at least during the COVID period and somewhat before that, we had a very prolonged period of low interest rates, and so yield investors were quite hungry, and willing to take on more credit risk. Um, you can argue different points about whether or not these organizations are sufficiently knowledgeable to be good lenders in the sense of managing the potential for defaults and things of that nature. You can also argue that there is an advantage in that, unlike traditional banks, the liabilities of a pension scheme or an insurance company are not at call. And so you're not going to have the run on the bank kind of event. And that makes lending for longer periods more tolerable, which is something that many borrowers like. Insurance companies like fixed rates. And again, many borrowers like fixed rates, whereas typical commercial bank loans are floating rate. So there are some reasons, both for the borrower and this new class of lenders, to want to participate. It's relatively new. I mean, this has been going on for 15 or 20 years at small scale, but really has blossomed in the last few years into, a big wholesale industry, similar to the private equity industry, which is now very large, even in comparison to publicly traded securities markets.
Perfect. Thanks, Dan. There's one of your references is a Fed paper on a very on the same topic of shadow banking and insurance companies and so on. And they had a quote that really caught my attention, and I think it's interesting because I want to ask you about where is this all going. So let me read the quote first, and then I'll set it up. We show that a combination of a retirement savings glut, low yields on safe assets, and tax arbitrage accelerated the development of shadow banking within the life insurance industry since 2010. And this is from Foley Fisher, Nathan and Heinrich. Nathan Foley Fisher, Nathan Heinrich, and Stefan Varani are U.S. life insurers, the new shadow banks from 2023. So very good paper. In the past, in Intelligent Risk, I've written about demographics. So it's a topic I'm quite interested in. And as soon as I saw that first part of the sentence, my eyes lit up. And that's what I want to ask you about, Dan. Obviously, the boomer generation in the U.S. Is historically large, all born after World War II. The generation that came after them is much, much, much smaller. And I think most people are aware of this, but your prime savings years are kind of after you have kids. They get out of the house. You don't have any major expenses. The mortgage is paid. You're saving for retirement, and you're putting away quite a lot of money. And of course, that money is going into banks, and it's driving, loans and other products that the banks are offering. That's coming to an end. The boomers are almost at retirement. I mean, the oldest boomers are obviously well past, but even the youngest boomers are getting to retirement age, and that ready source of capital is not going to be there anymore, or at a diminished scale. What does that do to private credit? Yeah.
Well, I think the issue is as less money from retirement activities flows into traditional banking. The amount of lending that traditional banks do is going to decline a bit. And so borrowers are going to be looking for alternatives. In addition, you have, again, and have had for quite a long time, the idea that when people are saving for retirement, they eventually stop worrying about the value of capital. They want income, right? They need to live off this money. And that tends to push them toward a more of a yield-oriented investment type rather than not. The other issue with shadow banking that I think is important for everybody in the U.S. to keep in mind is that shadow banking in the U.S., while existent, this idea that life insurance companies, pension schemes at large scale are to some degree replacing banks as commercial lenders, it's still relatively small. If you look at other countries like China, where there is a massive shadow banking system, both for private borrowers and largely local government borrowers, so towns, counties, infrastructure projects, building schemes. The net debt of local authorities in China is very, very, very large. Also, sort of joint ventures between property developers and local authorities that want to grow their communities. In the US, at least, the big debtor is the federal government. So the big net debt is the federal government. So it's a little bit of a different situation. Clearly, you're starting to see shadow banking in Western countries through non-bank banks, online banks that don't have physical presence anywhere, who may only, their loan portfolio, their lending portfolio may only be credit cards to retail individuals, or maybe only automobile loans. So these very specialized institutions that wouldn't really be considered a normal bank. But I think the Fed's concern is that, and it's a peculiar one to the U.S., is the fact that insurance companies in the U.S. are almost entirely regulated at the state level. And so if an insurance entity wanted to, let's say, lend more aggressively than a bank might be allowed to do, they might be able to jurisdiction shop, looking for individual states where there is a lack of regulation, or where regulation is very liberal. You could think at one end, for the life insurance industry, certainly, probably the strictest is the state of New York. They're quite strict about how the investments of a life insurance company are handled. There are many other states, Texas, Arizona, Vermont to a degree, where regulation is much more lax. And that's not to say it's insufficient. We're not seeing a lot of insurance companies go bankrupt, but it can happen. And even if the probability is low, it is certainly higher in some places than others.
Dan, I'm going to channel a lot of, I think, the authors and the readers of Intelligent Risk in my next question, because I do see a lot of, in the articles that I read, in the background, I see an assumption made by risk managers that regulation is the solution, and others where regulation is the problem. I'm interested to know your view of, can regulation fix this problem in private credit?
Well, I think regulation probably can't fix this problem, because whatever regulatory environment you're talking about, you'll find some other jurisdiction that will make it easy. If you think about the reinsurance industry, for example, there's a reason that most of captive reinsurers are legally located in places like Bermuda and the Bahamas, because regulation is relatively lax. Not as lax as it used to be, but certainly less so than it would be in let's say, a G7 country. So I don't think it's that. I think one thing we could do, which is more a style of regulation than it is the question of yes or no, is this idea that there's pretty good economic research that suggests that, given the risk of a financial entity's balance sheet, you can sort of fine-tune how much risk they can take in their investment activities, or vice versa. If you're taking a lot of risk in your investment activities, you probably should have less leverage on your balance sheet.
Right.
And there's pretty good economic theory going back to the 1970s. I think there was a paper of this sort by Litzenberger and Rubenstein in 1976 that said a very simple thing, which is, if you have both assets and liabilities on a balance sheet, your investments should be relatively conservative to the extent required to cover your liabilities. And then if your surplus can be invested in a more aggressive manner. And if you fine tune that well enough, you actually do two things. One, you reduce the likelihood of failure. And two, you actually, at least for long-term participants, make the entity more profitable. If you're a shareholder in a commercial life insurance company, you don't want the company to go broke. If you're a shareholder in a bank, you don't want the bank to go broke. And so there is a fine line between being more aggressive and not aggressive enough to satisfy the shareholders. But I think there's a lot of good economic theory about that regulators could encourage people to follow, or at least be familiar with, that says essentially what I just said, which is, invest relatively conservatively to cover your liabilities, and then you can be more aggressive with the surplus. And that seems to me to be just common sense, but you often see situations where regulators are perceived as the enemy of profitability, right? It's kind of the regulators versus the executive suite. So regulation is perceived as an impediment to profitability. As a financial institution, we'll always be more profitable if we get to do what we want. And I think if we just thought about it the way I just described it, and again, this has been in the economics literature for a very long time, you could come to a place where regulation and sound management really align. And regulation is not the enemy of profitability, but is a contributor to sound policy that would lead to profitability. That may sound a little, Pollyanna and sort of utopian, but I think the theory is there, and I think there are ways that we can do that. Again, the mathematics of this, some of it's a little arcane, but it's pretty straightforward to understand the simple concept. And again, there are some regulations in some areas where this already exists. If you think about, say, a property and casualty insurance in some countries, the regulation's pretty simple. You figure out, how much money you expect to pay out in claims over the next 3 or 4 years. You keep that in very safe investments like government bonds, and everything else you can do what you like. And it's not a particularly complex way of addressing that question. There are lots of mathematically sophisticated ways of addressing it. But I think the issue with regulation is to get away from the idea that it is an impediment to profitability. And that, I think, is really a question of aligning the interest of regulators and shareholders and guarantors like deposit insurance schemes and things like that. Everybody should be on the same side, which is to make sure that these organizations run in a prudentially sensible manner. And that should be beneficial to shareholders in most cases. So I think that's where regulation can help. Getting chief executives to deal with that in that way is a little tougher. One of the examples I would give that I think is quite profound is many of our risk management brethren would remember an incident some years ago referred to as the London whale, where a trader at JP Morgan started to lose a lot of money, and largely because JP Morgan had multiple risk systems and wasn't quite sure which one to believe, and they chose to believe the one that illustrated that the risks were low as opposed to the one that illustrated that the risks were high. There was internal dissent, and once it got all the way to people like the C-suite, Jamie Dimon, they dealt with it, and it got a lot of attention at very high levels within the organization. But it's an illustration that I think there is a perception that the risk that a financial institution is taking doesn't need to be managed. What needs to be managed for regulators is the appearance that we are managing risk. And because the regulators don't typically get down into the details enough to actually understand if the practices are sound. I'm not saying they can, because if you're regulating 5,000 institutions and they all do it a different way, that's not something that can be reasonably expected. But it's a tough one. You know, I once was asked to give a talk to the what is now called the Financial Conduct Authority in the UK. It was then called the Financial Services Authority. And they asked me to give a talk about risk. And I said, whose risk? Shareholder, the institution, the regulators, the guarantor scheme?
Yeah.
You know, whose risk are we talking about? And they just kind of went, all of the above. And it's a very different problem, you know, depending on, you know, whose perspective you're looking at.
Yeah.
So, you know, as far as private credit and private credit funds, on the one hand, you know, these big asset owners like insurance companies, particularly in the U.S., you know, they're big kids. They know what they're doing to an extent. I think one area that is potentially troublesome is the idea that in many countries, including the U.S., illiquid assets are often not marked to market. It's the classic sort of the assumption of fixed income, where you say, well, I'm going to hold this to maturity, so I don't care what the market value is. Yeah. And I only worry about the market value if I have to write it down because the thing defaults. There's a lot of room for that in private credit, because these instruments are very customized, lots of contractual provisions. It's not like a bond being traded in the market. And so there's a strong tendency to not mark them to market in a material way. And so it is very plausible that losses or potential losses could be hidden. The good news is, you know, in the long run, most borrowers actually pay. So the number of loan losses of this type is usually relatively modest, but certainly the idea of I don't need to mark to market can lead to lots of things. One being underestimation of risk. The other being what I call exercising the option to wait. This is less of an issue with private credit than property or private equity. But when we are involved in something like a private credit fund or a private equity fund, there is always uncertainty as to when the proceeds of the investment, the actual return, is going to be distributed back to the investors. And, you know, depending on who you are and what the liabilities look like on your balance sheet, you may not care. You may say, well, my liabilities are 40 years in the future, so I'm not worried too much about, you know, when I get paid. And it is better with private credit, because typically as borrowers are repaying their loans, some of that money is distributed to the investors. Some can be reinvested in new loans. With private equity, it's a worse situation, because typically the way you get money out is to sell the businesses that the private equity fund has acquired. And if you don't like the valuations that you're being offered in trying to sell those businesses, one of the things you do is you have the option to wait for better times. And that's all well and good, unless you have the circumstance as an investor that you were counting on the money now, either to fund other investments or to fund consumption. So it's a different type of risk that risk managers typically don't think about. If I'm reporting VAR to a regulator, for example, the time horizon might be 2 weeks. You know, how much could I lose in the next couple of weeks? Nobody thinks about the idea that, well, this fund, the money I'm going to get from it is going to come to me in between 7 and 12 years. And if I actually have a purpose for that money that's between 7 and 10 years out, that would be nice. But if there are difficult economic circumstances such that timeline goes from 7 to 12 years to between 7 and 25 years.
Right.
Now I've got a significant problem.
Yeah.
And that's an area of risk management that I think is very, very underdeveloped.
Yeah. Great. Yeah, there's obviously a lot of focus on private credit at the moment. So I think it's a really well-timed article for our readers to get a little more up to speed. And if you enjoyed our conversation, go ahead and read Dan's article in the August issue and plenty of the others. It's our biggest issue since I've been a co-editor. I think we have something like 20 articles in there. So keep sending us submissions. We're happy to have them, and enjoy the issue. And please join the LinkedIn discussion group where you can have a conversation with a lot of the authors after the issue comes out and keep abreast of some of these issues. I'll put a link in wherever I post this. Thank you very much, Dan, again. And
thank you, Carl. Have a lovely day.